The next chapter we need to talk about are just some closing details. Just some things you need to understand about closing and preparing for closing. So hopefully this will be useful for you. Y'all, in South Carolina, all real estate closings must be done by an attorney. Okay, and I remember that, by the way. Y'all, it's got to be performed by an attorney. Y'all, some states will use title companies and stuff like that. And obviously that's fine in states that allow it. But again, in South Carolina, all closings must be performed by an attorney. Okay, they will prepare or at least go over all the closing disclosures and stuff like that. Then it says the closing disclosure, or CD, you hear it called a lot, just short for closing disclosure. Y'all will show all the buyer and seller expenses. Y'all, the buyer will have a closing disclosure and the seller will have their closing disclosure, showing all their credits, debits, and so forth. And then it says possession will typically take place at closing. Talking about when does the buyer actually get possession of the property. Now I will tell you, you make sure you read the contract. I mean, what have you agreed to in the contract of sale? Because there's some options in typically in the contract of sale. Y'all could be at closing, but y'all in some cases it may stipulate 24 hours after closing or 48 hours after closing. So, y'all make sure your buyer knows when they can expect to get possession. Y'all, possession meaning keys. You can turn or you can move into the property. Y'all, if the contract says 24 hours after closing and your buyer shows up at the closing table in their U-Haul truck, thinking they're going straight to move in, and then find out they can't move in for another 24 hours, y'all, that could be a problem. So, y'all, typically, I think possession will take place at closing, but make sure you know what the contract says. Here we take a look at what the closing agent's responsibilities are. Well, first of all, who's the closing agent? That's the attorney. Part of what the attorney's job is, they will review the title insurance. They collect any funds due from the buyer or seller in some cases. It'd be kind of tough on the seller if the seller's got to come to money with closing, but or have to come to closing with money. But sometimes that happens. Complies with all the lender's instructions. They prepare all the documents we're going to need to close. They record the documents, disperse the funds, and then issue title insurance. You just see a list of things there what the attorney will have to do and prepare for. I guess one of the main things I would just say right here, because I think there is some confusion. I think oftentimes the buyer believes the attorney is representing the buyer at closing. And the reason they think that, and quite frankly, a lot of agents think that, is because the buyer is the one that chose the attorney. With buyer, just because you get to choose the attorney does not mean that attorney is providing you with any legal representation. The legal representation is coming from your agent buyer, right? And so if you're watching this video and you're getting ready to be a real estate agent, then just know, at closing, you are their legal representation. The attorney is not providing representation to anybody. They're there to make sure all the documents are signed and get them recorded, to basically process the transaction. All the representation should have already been done by the time you get to the closing table. So just to be clear. But the biggest part of closing is dealing with there's some math here. Prorating items. And there's three things primarily. There could be others depending on the transaction. But primarily there's three items that will have to be prorated for closing. And obviously the attorney is going to do all this stuff. So why do we have to know how to do it? If the attorney is going to do it, why do you need to know how to do it? Well, first of all, you've got to be able to fill out what we refer to as a net sheet. Buyer's net sheet. And if you're representing the seller, you need to do a seller's net sheet. Well, what does that net sheet do? What's the purpose of it? Well, if you're representing the buyer, and by the way, when should you fill out this net sheet? If you're representing the buyer, you need to do this before you make an offer on the house. Do not make an offer without doing a net sheet. Net sheet identifies all the costs associated with closing. So, the bottom line, at the bottom of that net sheet, it should say, at least for the buyer's net sheet, buyer, here's how much you're going to have to bring to closing if you make this offer and the seller accepts it. You better make sure the buyer's going to be okay with that, because, I'm just telling you, so often buyers are thinking, and maybe the buyer's getting 100% financing, potentially. Because there are several loans out there where you could get 100% financing, no money down, no down payment. And in the buyer's mind, that means I don't need any money to close. Well, you're going to find out rudely that's not the case. There are other costs associated with buying real estate. I'm not going to sit here and I'm not going to do a net sheet right now. Maybe we'll do something later on to show you how to do a net sheet. But anyway, the net sheet just consists of all the costs associated with buying the house. It could be a whole laundry list of things. Well, part of that net sheet would be some of like these three items here that would have to be prorated. Like mortgage interest, property taxes. Now that's going to be shared. Part of those taxes the seller will have to pay for. Part of it the buyer will have to pay for. If there are HOA dues, part of those dues the seller has to pay for. Part of it the buyer has to pay for. So we have to be able to prorate those items to be able to determine how much does the seller owe, how much does the buyer owe. All of this should be part of your net sheet. And just real quick, if you're the listing agent representing the seller, then obviously you need to do a net sheet for the seller. Now, when should you do that? I suggest you do a net sheet before you submit the offer to the seller. So if I'm the listing agent and I receive an offer from the buyer, then I'm going to, based on what their offer is, then I'm going to do a net sheet to figure out if my seller accepts this offer the way it's presented, then seller, this is how much you're going to get or walk away from the closing with. So here's all the costs to include the payoff, the mortgage payoff potentially, the prorated taxes you owe, prorated association dues, and there could be a lot of other costs associated with that. But anyway, so you need a net sheet. So that way, when you provide the net sheet to the seller, that they can understand what the offer means. Because just because they're offering $300,000 for the house does not mean you're gonna get $300,000. There are a lot of could be a lot of cost associated with the closing of the deal. So right here, we're going to look at how to prorate some of these items. Now, the mortgage interest, we've already been over that. We did that in the finance chapter. We'll do another quick example right here, but if you don't remember how to calculate the mortgage interest or interim interest, if you recall, because that's going to be an expense the buyer will have to pay, assuming they're borrowing money from the bank. But so if you need to, go back to the finance chapter, where we dealt with interest, and take a look at that. But let's look at an example of how we would calculate the interim interest, just sort of a review. But the example is this. If you close on November the 15th and borrow $175,000 at 6.5% interest using a 360-day year, y'all remember there's a difference between 360 days and 365 days. Remember, using a 360-day year, then we must assume there are 30 days in every month, regardless of how many there really are. So then how much would the interim interest be? All you have to do is take the loan amount, the $175,000, times the interest rate, which is 6.5%, and that will give you the annual interest you're paying on that loan. In fact, here we go. In fact, the annual interest will be $11,375. So we know that's the interest you owe per year. Well, y'all, we need to know how much it is, at least for now. How much is it per day? So if you take the annual interest divided by the 360 days, that's what it said to use for year, then we know the interest is going to be $31.59 per day. All right, well then how is the interim interest calculated? Well, we got to know how many. It's based on the number of days from the day you close until the end of that month. Okay, and by the way, you have to always count the day of closing for interim interest. Well, if we close on November 15th, then that would be 16 days that we have to pay interim interest. So 16 days times $31.59, we know our interim interest is going to be $505.44. Again, that will be paid at closing by the buyer. Buyer, you owe that. Again, even if you're getting 100% financing, meaning there's no down payment, you're still going to have to pay this. Now, could the buyer in their offer, when they made the offer in the contract, ask the seller to pay for all this stuff? They could, and assuming the seller agreed to it, then guess what, seller? Then it's going to be an expense you have to pay, right? So either way, we need to know how to calculate this, and I think that's pretty cut and dry, pretty simple to figure out what the interim interest would be. Now we have to deal with the property taxes. And I said earlier, when it comes to the taxes, the seller will owe some amount, the buyer will have to owe some amount. Because, in fact, the way you have to think about it, what the seller owes is from January 1st, from the beginning of the year, all the way up until the day of closing. So, seller, you owe all that from January 1st to whenever you close. Now, the buyer's responsible from the day of closing until the end of the year, right? So now we have to prorate that to figure out how much does each party owe. So again, if we close it on November the 15th, it says taxes are $1,200 per year, and again, using a 360-day year. What is the tax liability for the seller and or buyer? Well, again, so I know I've got to figure out how much are the taxes per day. So if you take the $1,200 divided by 360, then we see that's going to be $3.33 per day for taxes. Well, then how many days did the seller own that property that year? Again, from January 1st to November 15th, is 315 days. So you multiply the 315 times the 333, That means, seller, you're going to be responsible for $1,048.95. Now, y'all, here's where it starts getting confusing for a lot of people if you're not familiar with this. When the county sends out their tax bill, they will probably, they usually send out the tax bill probably right around this closing, around mid-November, December time frame. That's when they send the tax bill out. Now, when you receive the tax bill, that will be the amount you owed for the previous year. Not for the upcoming year, but for the previous year. So, and it'll be due January 1st, or maybe sometime first part of January is when they expect you to pay the taxes for the previous year. Well, when they send out the tax bill, they being the county, when the county sends that out, they're going to send the bill to whoever the current owner is. So in this case, the buyer who has just bought the property is now going to get the tax bill, and the county's not going to prorate that tax bill. They're going to send the entire $1,200 bill to the buyer. And guess who's got to pay the full $1,200? Buyer. You got to pay the whole amount. So the way we're going to do this is, when we close, we know that of the $1,200, $1,048.95 is what the seller should have to pay for. So basically, the seller is going to give that $1,048 to the buyer at closing. So again, if on the seller's net sheet, you should see a deduction, a debit of $1,048.95. And on the buyer's net sheet, it will show as a credit, right? Because they're going to be receiving that amount. And you're going to get that at closing. Now, buyer, and I have to tell every buyer this, when you get that check, when you get that money, I suggest you don't go spend it somewhere, because you're going to need that when the tax bill comes due. Because you're going to say, well, I've only been here for a month or 2 months, and you're telling me I owe $1,200 in taxes? Yep, you got to pay the full amount because you received $1,048 from the seller, right? They've already given that to you at closing. So on the settlement statement, it will show a credit to the buyer and a debit to the seller in the amount of $1,048.95. When we start talking about these credits and debits, this is where a lot of people tend to get confused for some reason. But just got to remember, it's all I can tell you. All right. Now, when it comes to the HOA, the homeowner association dues, first of all, it's important to understand this. Typically speaking, this may not be every situation, but typically speaking, HOA dues are paid at the beginning of the year, but when you pay that, say in January, that payment you just made is for the upcoming year. So basically, you're paying HOA dues in advance. That's different than the property tax. Remember, when you pay the property taxes, that was for the previous year. But when you pay the HOA dues, this is for the upcoming year. Here's why that's important. Say we close on November 15th, the dues are $550 per year. Again, if we close on November 15th, the seller has already paid the full year, $550. It's already been paid for the full year. So obviously, now buyer, because you're going to buy the house in November, you need to reimburse the seller whatever the dues would have been from November 15th through the end of December, right? So we got to prorate that to figure out, well, how much does the buyer owe back to the seller? Well, y'all, same thing. We know it's $550 a year. So to figure out what it is per day, we divide the 550 by the 360 days, and it comes up with $1.52 per day. Well, how many days does the buyer own that property? Y'all, from November 15th to the end of the month, be 45 days. So 45 times $1.52 is $71.20. But y'all, again, that's what the buyer now has to pay back to the seller, because the seller's already paid for the full year, right? So on the settlement statement, it will show a credit to the seller and a debit to the buyer of $71.20. Okie dokie. Y'all, I hope that makes sense. I just don't know how to explain it any better than that. But y'all, again, I think where people get confused, y'all, especially if you're doing a math question on the exam, we can figure out. It seems like they can figure out that the prorated amount is going to be $71.20. Where we get confused, is that a credit to the buyer or a credit to the seller? Debit to the buyer or debit to the, we get these debits and credits mixed up. So, y'all, if this will help you and you can remember this, then good. But y'all, if you're dealing with HOA dues, it's always a credit to the seller and debit to the buyer. Always. If you're talking about property taxes, then it's always a credit to the buyer and debit to the seller. I guess you just got to put that down as a memory item. HOA dues, credit to the seller, debit to the buyer. If it's property taxes you're prorating, it's a credit to the buyer and a debit to the seller every single time. So if you can remember that, then all you got to do is figure out what this prorated amount would be and who's going to get or have to pay however much. All right, so y'all, there's your prorations. Y'all here they're talking about some common terms and elements for closing. Y'all, obviously the attorney will disperse funds out of the escrow account according to the contract. Then you see what the settlement process is. Y'all, they list 5 steps here. Y'all, I'm not going to sit here and just read those to you because y'all, you can see them yourself. But then, y'all, at the end of the day, y'all, the buyer has signed everything they're supposed to sign. Seller has signed what they're supposed to sign. And then that, in effect, will transfer the title from the seller to the buyer. And voila, you got to close it. Now, we already talked about the fact that we have to have an attorney to close the real estate transaction. But in paragraph 2 here, y'all, it lists what the licensee's responsibilities are at closing. And y'all, here's what I want you to understand here. Y'all, by the time you actually sit down at the closing table, your job should be done. In fact, there should be nothing you need to be talking about at closing. You should, in fact, does the licensee even have to or need to go to closing? Not really. There's nothing for the licensee to do at closing. Again, your job should be already done. Y'all, if you find yourself having to do something at closing, that means you haven't done your job. Now, am I saying licensees should not go to closing? No, I'm not saying that. That's not what I'm saying at all. Y'all, if anything, y'all, you sit there, to make your client feel better. So your client is not nervous about what's going on or whatever. But again, at the end of the day, it should be done. Now, if your client starts asking a bunch of questions, like, things they don't understand, y'all, that does not look good on you. That means you have not done your job at all. You have not done your job. Y'all, by the time we sit down at the closing table, your client, whether it be buyer or seller, should just be ready to sign because they've seen it. Y'all, should you have already gone over the entire settlement statement, all the debits, all the credits, so they know exactly what's going on here. Here's how much you're paying. Here's how much you're going to get from the other party, so forth. Y'all, you should have already done all that, all way before closing. And if there's any questions or anything that you or your client don't understand, y'all, you need to be getting answers to that before closing. Y'all, you don't wait to closing and go in with questions. So just, once we get to closing, it should be just a time to sign some documents, shake hands, hug, and move on, right? That's what we're supposed to do here. All right. Y'all, we know we have to account for and maintain documents and stuff like that. That's really all they're talking about here. Just make sure you keep everything in your file. And by the way, the attorney will give you a copy of all the closing documents. Once they're all signed and everything's done, they'll give you like a little folder, usually with all the closing documents in it. You need to put that in your file. And you got to maintain all this stuff for a minimum of 5 years. And then last thing we need to talk about are these transfer taxes. You hear these transfer taxes referred to as 2 or 3 different names. They could call them transfer taxes. They could call them deed stamps, which quite frankly is what is most commonly referred to here, at least in this market, or sometimes documentary stamps. But it's all the same thing. All it is a tax charged to the seller at closing. So how much is this tax? It's $3.70 per thousand in sales price. Now, that $3.70 per thousand, and it actually even goes, or $1.85 per 500 if you wanted to break it out that way. That's a memory item. You have to memorize how much these taxes, transfer taxes or deed stamps cost. You will have to do some math to figure out how much these taxes are, and they're not going to tell you how much. They're not going to tell you the $3.70 per thousand. You're supposed to know that. But as long as you know they're $3.70 per thousand or $1.85 per 500, and you know the sales price, it shouldn't be too difficult to figure out how much that tax or deed stamp is going to cost. Now, it does say here in paragraph 3, and I'd pay attention to this, or this could cost you a question if you're not careful. If the sales price is not an even 500, then you must round the sales price up to the nearest 500. Y'all do not round down. If you round down, you're going to be off by at least $1.85. I promise you. So, if the sales price is an even 500, then all you got to do is multiply that by the 370. But if it's not an even 500, then you're going to have to round it up to the nearest 500, and then you can calculate the cost. So let's look at an example. Said a house sold for $225,000, $300,000. How much are the transferred taxes? Well, first of all, is that sales price an even 500? No, $225,000, $300,000. So that means you're going to have to round it up to the nearest 500. So it should be $225,000, $500, right? And then, how many thousands are in that sales price? 225. Anyway, 225. So you multiply 225 times 370, which gives you $832.50. But there's an additional 500, right? And we know each 500 is $1.85. So if you add $1.85 to that, then that would actually give you $834.35. It's not too hard. Again, so really the main thing you need to remember, if it's not an even 500, round it up to the nearest 500. And then you must memorize. They cost $3.70 per thousand of sales price, or $1.85 per 500. That's just pretty much memory items right there. But that's how you do the transfer stamps or deed stamps. And again, this is a charge, a tax charged to the seller at closing.